Hello and welcome to Questioning the Manager. Today we are joined by Neil Hermon, who is the Fund Manager for Henderson's Smaller Companies Investment Trust. Neil, thank you for joining us. So last year was a strong year for UK equities in general. How has the first few months of 2018 been for the UK small and mid-cap market?
Actually, 2017 was a very strong year. 2018, so far year to date, equity markets in the UK are reasonably flat, so up one to down one, depending on what size band you're in. That kind of masks what was a pretty poor Q1, principally affected by the potential trade war, Trump's tariffs, strength of sterling, and the ongoing Brexit concerns. But April may be much stronger so far. We're now back to flat. Really the reason for that is, I suppose, weakness of sterling, which has certainly helped some of the bigger, large cap companies.
It's well documented that the team employs a bottom-up approach to portfolio construction, but I want to know if there are any themes that you can pick out from the current list of stocks.
As you said, very much bottom-up, stock-driven, finding those high-quality businesses which will drive long-term returns for shareholders. We look exactly from a bottom-up perspective, therefore top-down doesn't play as much a part as that kind of the key drivers of our stock selection. However, you look at the portfolio, some of the key themes are we're overweight growth, as you'd expect, being a GARP style, so those kind of growth-type sectors you'd expect. We've got a high portion of overseas exposure as well, so about half of the portfolio from a sales perspective is in overseas markets, which are benefiting from their strong growth overseas. And underweight in those very much the structurally challenged domestic areas like retailers and travel and leisure.
Have you made any significant changes to the portfolio in terms of list size, gearing, sector or cap weighting?
No, we're very long term in our approach. Average holding period of stocks in the portfolio is 4 to 5 years, so there's not rapid change. You think about the fund as it stands today, number of holdings is quite consistent, around 105 to 108 as it was start of the year. Gearing is in about 8% currently, again a very similar level. We're always adding stocks and taking stocks away from the portfolio, looking at new ideas and finding things to sell. 3 or 4 new aims in the quarter. We added Spire Healthcare, hospital operator. We added Integrafin, B2B platform for IFAs, and Impacts Asset Management. On the other hand, we sold Superdry, holding an Arrow Group, and NMC, which became too big for the fund.
There's a general consensus that the worst of Brexit has already been priced into UK equities. But I want to know, how do you feel the small and mid-cap market has reacted since the referendum result?
It's certainly the case the UK market is unloved by investors, both international and the UK. That's been evidenced by the low valuation of UK equities compared to other territories. And the obvious reasons, you've obviously got Brexit, you've got the slowest economic growth in the G7 as we stand today. How we positioned for that, exactly a point about the overseas exposure helps from that perspective, and trying to find those growth companies and avoiding some of the more domestic areas exposed to Brexit. In terms of how companies are getting on with it, they're getting on with it. We don't know the conclusion for Brexit. There's various scenarios that could happen. Fundamentally, we are seeing some weakness in some of the high-end ticket items in the UK, things like kitchens and cars and double glazing. On the other hand, some of the companies exposed to overseas markets are generally performing very well, helped by weakness of sterling and also strong international growth. So, on the whole, markets are getting on with it, and we'll find the conclusion in 2019.
Neil, it's been an absolute pleasure. Thank you for your time.
Thank you.